The economy never stops moving. Markets shift, businesses rise, big ideas break through. I'm Dr. Gus Lazopoulos, and this is the Entrepreneur's Edge. Every week, we break down the economics, the strategy, and the decisions driving today's biggest moves. Sharp, clear insight that gives you your edge. Welcome to the Entrepreneur's Edge. Let's get started.
Hello everybody, and welcome to the Entrepreneur's Edge, episode number 2. So my name is Dr. Gus Lazopoulos, and I'm going to be the host of the show today. And this is going to be our second episode. So today I want to talk about something interesting that a lot of entrepreneurs have access to. And of course, we're going to look at some of the strategies on crowdfunding. Now, if you remember, in the first show, we talked about, how to get resources, right? Because one of the biggest challenges for entrepreneurs today is getting the funds, getting resources that they need to be able to get their businesses off the ground. Now, statistics show that over 65-70% of entrepreneurs that are starting up their companies are bootstrapping. So the definition of bootstrapping is basically using your own funds, right? Lines of credits, savings, putting a loan on your house, things that can potentially create tension in a family, and things that can potentially, if the business doesn't do well or it fails, it can cause a lot of problems. So of course, one of the things that you have to look at with entrepreneurship is the ability to mitigate risk. So crowdfunding, of course, is something that has been around for the last, I would say, 15 years, since the early 2010s. It started off with reward-based crowdfunding. And then, of course, over time, crowdfunding has been moved into equity-based. Now, typically, when businesses raise money, private corporations that raise money, they would go through what's called a private placement. And so you would bring in investors. The investors would have to be eligible to invest in your business. And so in that particular case, it would be very costly, like if you get a lawyer to draft an offering memorandum and legal documents, it can be quite expensive to raise the capital. With crowdfunding, however, there are more relaxed rules. I mean, there's still limitations, but at least if you're a brand new company, crowdfunding can do two things. Number one, it can help you, three things actually. It can help you promote your product, validate your product, and also be able to get the capital that you need, right? However, when you're starting a crowdfunding campaign, it's not as simple as just going onto Kickstarter, Indiegogo, setting up a campaign and hope for the best. That's not how crowdfunding works. It's very important that before you even launch your campaign, you have to be able to build traction in your marketing. Now, you may not have a product right away. There's a lot of startups that either have a prototype or they have an idea. Some organizations are at different stages of their venture, depending on where. Some are even operating and are looking for expansion money. So crowdfunding doesn't only work for the entrepreneurship side, sort of the startup side, but it also helps with businesses that want to expand, right? However, there is an art to it, right? And so, yes, according to statistics, very few campaigns actually hit their targets or above their target. But again, you have to look at the campaigns that are successful versus the ones that are not successful, and we have to look at them carefully. So before we get into that, let's go over some numbers here. So I'm going to look at Canada versus the United States. So first, let's talk about the Canadian legislation that governs crowdfunding. So the legislation, and again, this is a fairly new law. When I mean new, I mean in 2021, the law was passed in Canada to allow equity crowdfunding. Before 2021, equity crowdfunding was not allowed in Canada. Mostly it was reward-based crowdfunding. If you go back to 2012, the United States pushed what's called the Jobs Act of 2012, and we'll also talk about that as well. So the equity crowdfunding falls under what's called N145-110. So this is called the National Instrument N145-110. So in a 12-month period, a company can raise up to $1.5 million. However, it doesn't mean that one person puts $1.5 million. No, there are also restrictions to the amount that each investor can put. But the whole point is, if you go out to the crowd, you can raise a considerable amount of money. And so for a small company that is trying to get themselves started, get footing in the market, $1.5 million is not a bad amount of money to have if you can get that kind of funding raised. So the thing is going further, there are investor limits, of course, under that NY 45-110 rule. Again, private placement eligible investors fall under a different category because to be an eligible investor, you'd have to make a certain amount of money. I believe accredited investors have to make either a married couple combined of $300,000, or an individual can make $200,000, or they would fall under the offering memorandum. However, in a crowdfunding under the NI 45-110, anybody can be an investor. However, the maximum an individual investor can invest is $2,500 per offering, regardless of what their net worth is, right? So anybody, it could be your friend, it could be your coworker, it could be anybody that you're targeting can invest. So if you add it all up, if you have, let's say, 1,000 investors, do the math, you can raise a considerable amount of money. Now, if you want that investor to put more money up, then you would have to get what's called a registered dealer involved. This is an exempt market dealer. Again, usually exempt market dealers are licensed to sell exempt market products to eligible or accredited investors. But with an exempt market dealer, we can raise that amount to $10,000 per offering, any investor. So the dealer would make, so if you want to be able to increase the amount by 4, you can make it up to 10, right? So that's pretty much how it works. So for example, if your startup needs, let's say, $800,000, you can get 320 investors. They put either $2,500 each, or 80 investors at $10,000 each under an exempt market dealer. So let's say you have an EMD that has a group of investors. They're always looking for the latest startup. These are millionaires, and they don't mind putting 10 grand in. You know, for them, it's not a big deal. They'll probably set aside money for certain ventures. So again, there are ways that you can utilize under the law, under these regulations, to raise money. Now, one of the things that I want to be very clear about is that when you're raising money, let's say you want to raise $1 million, don't put the funding, because when you put the campaign together, there is what's called the target amount that you want to raise. You don't want to put that bar too high. Let's say you aim for $50,000, because some campaigns will not give you the money unless you get to a certain target. Okay, so you get to a certain target, and then you can exceed that target. So there are campaigns that aimed at $50,000 but ended up raising $1 million. Now we'll talk about in a moment some of the strategies that you can actually put together to create a successful campaign. So we're going to get to that in a moment. Now, some of the funding portals in Canada will include, this is for equity now, will include Front Funder, that's FRONT Funder, Equivesto, Vested, and CVX are some of the portals that you can use in Canada. And again, this is for the equity. Now, the other side of it is the reward-based crowdfunding. So the equity is you're going to set aside equity for investors. So let's say your company has authorized shares of 15 million shares, and you're willing to give up 10%, which is 1.5 million shares. So you determine what the value of those shares are, and then based on the amount that you're raising, this is the number of shares that those investors would get. Now, of course, you would have to value your company. And normally, if you're a company that is not up and running yet, the valuation, you'd have to do what's called a pre-money valuation, right? And so to determine what your company's worth. Even though you don't have revenue yet, having intellectual property, technology can actually also help create some value in your company, right? So there's many ways to do that. The reward-based crowdfunding is different. So instead of giving up equity or a percentage in your company, what you would do is you would give an incentive for somebody to put money in your business. So if you're selling, this would work really well if you're selling a physical or a tangible product. Even software, but with software a little bit more tricky. So maybe you're giving an incentive to an investor. You're saying if you put in $1,000 or $200, we'll give you a year's free membership. So that value might be worth $3,000 or $4,000 as an example, but you're giving it to them for $1,000. So when you're dealing with investors, you always want to make sure that you're giving them that value, right? So that's very important because with reward-based crowdfunding, yes, there are a lot of people that want to back a project up, but like anything, human nature says people want to get something out of it, right? And so you want to always target the early adopters, right? The individuals that are open to new ideas and new ventures that are willing to try. So we're going to get into that in a moment. Now, on the U.S. side, again, just like anything, they're a little bit more flexible than Canada. The maximum a company can raise is $5 million, not 1.5. So it's amazing, a huge difference when you're going to the United States in a 12-month period. Okay, so the minimum raise, there is no regulatory minimum raise under the U.S. laws. Again, normally the securities laws, typically under the Securities Exchange Commission in the United States, it's federally regulated, where in Canada, every province has their own exchange commission, like the Ontario Securities Exchange and others. So, of course, that's where the rules come from. So the company will establish its own minimum funding target and maximum offering. And again, when you look at your minimum, try to keep that as low as you can, right? You don't want to set the bar high, because if you don't reach the minimum, you may not be able to get even the small funding, right? So you always want to be realistic with that. Not that many campaigns raise $1 million, but again, it's good to study. I'm actually in my PhD studies that I'm doing right now under the second dissertation that I'm working on. I'm really studying crowdfunding campaigns in detail to really see what the successful campaigns are doing and how that can translate to successful longevity of an organization. Now, the Securities Exchange Commission uses income and net worth tests for non-accredited investors. So they're a little bit more flexible. They're not as rigid. So if either the annual income or net worth is below $124,000, the investor may invest the greater of the $2,500 or 5% of the greater of the annual income or net worth. Okay, so again, if the income is higher, they can invest more. So if both the annual income and net worth are at least $124,000, the investor can invest 10% of the greater annual income net worth, subject to an annual cap of $124,000. So in essence, there's the limits are a little bit higher. in the US than in Canada. Now, the question is, where do I establish my campaign? It depends where your business is located, right? If you're established or you're set up as a US company, you could set up a Delaware Corp. They're quite easy to set up, a C Corporation. You can do your campaigns in the US, right? If you're a Canadian corporation, whether you're provincial or federally incorporated, then you would set it up as a Canadian campaign. So it depends on how your business is structured. Now with our startup, we're set up in the US because we're trying to create a global product. So, and it gives us more flexibility to be able to raise more money. So again, it all depends where you are, right? So these are the comparisons of the two different regulations. So for example, if we're looking to raise $3 million, we can have 1,200 investors at $2,500 each, or 310. Again, these are just sort of the examples, right? We can do. So when you look at it, there's a lot of investors out there. The key is you have to be able to capture their interest, because there's a lot of projects out there. There's a lot of people that are trying to raise money. So investors are always looking for traction. So what is some of the traction that these projects are projecting? Now let's move on to reward base. So this is where many entrepreneurs become interested, because the funding potential is often driven by market demand. So in Canada, there is no securities laws maximum on the amount a company can raise through reward-based crowdfunding. Why is that? Because you're not selling securities, you're not selling shares, right? You're basically, what you're doing is you're pre-selling a product or a service. So that would not fall under the Securities and Exchange rules and regulations. So that's some of the things that you need to take into consideration. So the practical limits come from the platform's policies and the business's ability to fulfill the promised rewards. So whatever rewards that you're offering, you need to make sure that you can fulfill them. So again, we still do have the consumer protection, tax, and advertising laws still do apply. It doesn't mean it's not regulated, it's just regulated under a different set of rules and regulations. In the United States, it's the same principle applies. So platforms such as Kickstarters and Indiegogo do not impose regulatory funding caps. Okay, so now that we've talked about the rules and regulations, because maybe some of you, the viewers out there, may not have an understanding of how crowdfunding works in Canada versus the United States. But just to let you know, you can raise up to $1.5 million in Canada and $5 million in the US under a single project. And for a startup, for a brand new company, that is a considerable amount of money, right? You can do a lot with that money. You can really get your business to the next level, to the point where you're now ready to approach angel investors or even venture capitalists. And again, we'll talk a little bit about the venture capital requirements in a different show. We'll go into that in more detail. Now, the next part that I want to talk about is how do we get involved in crowdfunding? Well, again, there's Kickstarter, there's WeFunder, and then all of these, there's Fundraiser, there's, what are the other ones called now? There's several of them. Equivesto, Vested, SVX, and many other platforms that we can use. However, going onto those platforms and setting up a campaign is not enough, okay? And I got to repeat it. If you do that alone, your campaign, I guarantee you, will fail. I've tried that in the past. It did not work. Okay. So not even if you have the best project in the world, you can have projects that has all the potential in the world. The key is you need to get traction. So before you even get into the actual crowdfunding campaign, what you need to do first is start building content for your product. So even if you don't have a product yet, that's okay. The key is you want to create content around your product that is going to create interested followers, right? So you want to build your followers list. So you would set up a Twitter, now it's called X, set up a TikTok, Facebook, Instagram, LinkedIn, and YouTube channels, whatever it is that you need to do. And of course, what you also want to do is build a landing page. And so what you do is you would promote what you're doing. So it's not just promoting your product, but you're also creating content that people are interested in. So if you are solving a particular problem, the whole reason why you're getting into business as an entrepreneur is you're identifying a problem, and then you're finding a solution to that problem, right? And then around the problem that you're solving, you're going to find content that's going to capture an audience. And you want to be able to then do your research and find out, okay, all of these crowdfunding investors and even customers, right, depending on the type of campaign that you're doing. So whether you're doing reward-based or equity, you want to be able to do some research to find out, where do I capture this audience? And so you want to target that audience to become your followers first. And I mean, I can't give you a timeline how long it takes to do what's called a pre-crowdfunding campaign. So you would get people into a newsletter, you start building the list, you engage with your audience, you get them excited. And once you get a big enough list and there's an interest, then the next step would be is to go and set up your campaign. So you pick a platform, whether you're doing equity or reward based. It all depends on the strategy that you're going to be putting in. And what's going to happen is you're going to set up your campaign. Make sure you put a lot of detailed information about your project. You want to have a video about your project as well. You want to keep it simple. Don't put too much information overload, but just enough to get people to understand what you're doing. Now, with crowdfunding, right, the campaign, in my opinion, and based on some of the studies that are shown, you don't want your campaign to be longer than 30 days. Okay, so you're going to set a target. Let's say I need to raise $50,000, right? Now, what you have over the last 6 months, 1 year, depending on, even longer, depending on the followers that you have, because most companies before they launch, and I made this mistake with my startup as well, is we were so focused on building the platform, we completely forgot about marketing. So of course, learning from my mistakes, I want to be able to kind of share that with the audience. So when you're doing a campaign, or when you're developing your product, what you want to do first is build traction on marketing as well. Get people to follow you, create content around your product. Again, don't push your product. It's not about promoting your product. You're indirectly promoting your product by giving information to your target audience that has a problem in the market. And so they're going to take an interest in what they're reading because they want to be able to solve a particular problem, whatever that problem is. And for Parecia, the biggest issue is, number one, people are losing their jobs. People are looking for alternative incomes. They don't want to rely on a corporation anymore because you hear in the news all the time, people are getting laid off. And so on the service side, there are a lot of people that want to provide their service. On the customer side, same thing. People want more options. Sometimes they have a hard time finding a particular service provider or somebody they can trust, or creating a community between service providers and customers will solve a local problem, right? And so we can create content. This is just my example around that. So depending on your venture, you want to be able to create content around the problem so that you create interest. So now all of a sudden you have an audience that is interested in what you have to offer. And so when you do that, you start to get a followers list. Now, I don't want to say you should have 5,000 people following you, 10,000. The more the merrier, of course, right? But once you have a sufficient amount of followers around you, then what you want to do at that point is you want to start doing some surveys, find out where people are at. And of course, if you're doing an equity campaign, you want to target investors that are interested in the type of venture that you're doing. So again, you might be targeting, number one, your target audience. So in a reward-based campaign, your target audience are the ones that are interested in your product, so they will back your product. However, if you're doing an equity campaign, you're looking more for investors. So these investors are willing to take risk on your business. And so they're interested in your area. So you want to target investors that are interested in tech or whatever it is that you're doing, because you could be raising money for different projects. Get them to follow you. So for them, you would set up, provide them investment content on what you're doing. So you get them all excited. So when you launch the campaign, you're going to say, hey, the campaign is starting on this particular date. So when you launch the campaign, now you've got what, 4,000, 5,000, 10,000 people following you. Again, it depends. This could be customers, investors, etc. Then you're going to direct them to the landing page or the campaign page. So the first 48 hours of your campaign is crucial. If you can get that audience that you've built over the years, direct them to your campaign, then you can get what's called a spike. So once you raise a certain amount of money, then what ends up happening, the platform algorithm will kick in. And so your campaign will be moved to the top of the list. And then you'll be able to get outsiders, meaning people that are outside your circle, coming to your campaign. Okay. Now, while you're doing that, you're also going to run advertisements in those 30 days as well, right? So you're really going to push traffic right through that campaign. And so you're going to set a goal of 50,000 as an example. And depending on how well the campaign does, if we surpass 50, we get to 50. But if we might end up raising 100,000, we might end up raising $500,000. There are some campaigns that have raised $1 million, right? I mean, I can't guarantee that you're going to raise $1 million. However, that is a strategy that would work in a crowdfunding campaign. You can't just simply set up a campaign and hope for the best, right? People really need to know what you're doing, right? So that's very important. And so these are lessons that I had to learn personally. And so now we're regrouping, we're re-strategizing. Like anything, with every startup, you have to pivot. And if something doesn't work, we have to go back to the drawing board, make corrections, and go back in again. So that's pretty much what I wanted to talk about today in terms of crowdfunding as a way to be able to get the initial capital. Now, remember, when you look at a business goes through what's called a cycle. So there are multiple cycles that a corporation goes through, right, or a business. So you first start out with the idea, right? You have what's called a eureka moment. The light bulb goes off, right? Now, again, ideas are a dime a dozen. I talk to people all the time. People have ideas, but it stops with the idea. The hard work starts after the idea. You have to validate the idea. You have to do research to see how you can take that idea and commercialize it into a business. Many times founders have to dig into their own pockets to be able to get a prototype or idea going. But of course, today there are options, right? And so if you have some savings that you can afford to risk, go for it. But never, never, never mortgage your property. Don't risk your family. Don't risk, the well-being and finances of, family. That's. I know people say entrepreneurs have to take risks. Absolutely. But you want to be able to take calculated risks, right? Never risk what you cannot afford to lose, right? That's the advice that I want to give my viewers today, right? You want to be able to be smart And you want to be able to use the strategies to help you minimize the risk. Yes, entrepreneurs have to put skin in the game. I agree. But putting skin in a game does not necessarily mean risking everything that you don't know. Skin in a game can be, okay, I'm going to put $10,000 in to get it started. And then I can bring other backers in, take the business to a certain level. So you're at the beginning of the cycle. We have pre-seed and seed capital. This is before the business starts. The crowdfunding can really help us get over that hump. We get the business into operations because, like anything, a business is not going to be profitable right away. Most likely we're going to be operating at a loss. But once we get over that hump and we can validate the idea, even on a smaller scale, you pick one small market, you test it there. Once you validate it, then you can move on to a venture capitalist. A lot of mistakes startups do is they go to a VC thinking, oh, I have the greatest idea in the world. I think a VC will back me. Now, statistics show that less than 1% of companies that approach a VC get funded. Why is that? Number one, venture capitalists are looking for high growth potential. So if you're opening up a small business, you're not going to get a VC. I'm telling you right now. VCs will throw $5 million and hope they can exit with $100 million plus in 5 years, right? So they really want to get a high turnover. Once you validate that idea and your business has potential to become duplicatable, now with tech startups, because there's less brick and mortar, mostly online, we can really expand into international markets fairly quickly. And once we test it in one market, we can then duplicate it. Of course, we're going to have to adapt the product depending on the different markets that we go to. And then from there, you become what's called a high growth company. Normally, a VC will either want to sell everything to a private equity company or do an IPO, right? And as a founder, to be honest, at the end of everything, if you're left with 25-30% equity, you're good. And Jeff Bezos had 12% equity in Amazon, and he did quite well, right? So you want to have the bulk of your equity early in the game. You don't want to give it all up. This is called cheap money. So if somebody says, I'll give you 50,000, give me 30%. No, don't make that mistake. It's called cheap money. You don't want to do that. What you want to do is try to get your business over the hump without giving so much equity. And then when you get to the position where the valuation of the company goes up, that 30% or 25% that you're left with has a lot more value than the 80 or 90% you had when you started off, right? So these are some of the strategies that you want to think about when you're looking at growing your business. So that's pretty much all I wanted to talk about today. I just wanted to kind of touch on the crowdfunding. And again, I want to thank everybody for their time today. And of course, in future episodes, I am going to bring in a guest as well, where we can actually converse in more detail. So again, thank you very much, everybody, for your time. And again, have an excellent day, and we'll see you in the next episode. Thank you. Bye-bye.
That is it for this week on The Entrepreneur's Edge. If it sharpened your thinking, subscribe and join the weekly newsletter for more. I am Dr. Gus Lazopoulos. Until next week, keep your edge.